Welcome to the Mortgage Foundations podcast, where we are here to guide you through the ins and outs of the mortgage world. Get ready to unravel the complexities and gain a solid understanding of everything you need to know about mortgages. Whether you're a first-time homebuyer or a seasoned homeowner, we've got you covered with expert insights and tips. Let's dive into the fascinating world of mortgages together. In today's episode, Tyler Cowell, the principal broker of Mortgage Foundations, FSRA number 13614, will discuss the similarities and differences between a variable rate and an adjustable rate mortgage.
So you've come across these terms, variable rate mortgage and adjustable rate mortgage, and you're curious to know what exactly sets them apart. Well, let's dive right in and explore the differences between these two commonly used terms in the world of mortgages. When talking about mortgages, the interest rate is a crucial element to consider. It determines the amount of interest you'll pay on your mortgage and affects your monthly payments. Both variable rate mortgages and adjustable rate mortgages have interest rates that can change over time based on the lender's prime rate, but there are some key distinctions between the two. A variable rate mortgage, also known as a static payment variable mortgage, is a mortgage where even as the interest rate changes, your payment remains the same. What does change is how your payment is allocated between principal and interest. As interest rates rise, more of your payment will go towards interest with less towards principal, and vice versa when rates come down. The payment on a variable rate mortgage may need to change if interest rates go too high and the payment isn't enough to cover any principal at all, which can result in a mortgage that grows instead of reduces. Lenders will commonly contact clients to advise them of options in order to not let this happen. Some lenders will even automatically adjust the payment as well to ensure there is always a little bit of principal being paid down. On the other hand, an adjustable rate mortgage is a mortgage where the payment fluctuates in lockstep with interest rate changes. When interest rates go up, so too does your payment. Although, when rates come down, your payment does as well. This type of mortgage ensures that your amortization remains the same and you are always paying down principal even when rates are going up. There can be some pain and decreased cash flow when rates are going up. However, a decrease in rates will result in some breathing room due to an increase in cash flow. The frequency of rate adjustments on a variable or adjustable rate mortgage can vary. Many lenders typically adjust the rate in the next month following the rate adjustment, while others will adjust it right away. If you have a variable or adjustable rate mortgage, it is important to know when your lender makes their change so you are well prepared. Most lenders adjust their prime rate based on the Bank of Canada's policy interest rate, which has the potential to be adjusted as many as 8 times a year. It is recommended to know when these meetings are. The next one is April 10th, 2024. When deciding between a variable rate mortgage and an adjustable rate mortgage, there are a few factors to consider. Firstly, think about your financial situation and how comfortable you are with potential changes in your monthly payments. If you're on a tight budget and prefer a more predictable payment structure, a fixed-rate mortgage may be a better fit. On the other hand, if you have some flexibility and are prepared for potential rate adjustments, a variable rate or adjustable rate mortgage could be worth considering. If you are prepared for some risk and still want the certainty of a fixed payment, then a variable rate mortgage may be the most suitable option. However, it is important to understand the risks of that fixed payment. Remember, choosing the right mortgage type is a significant financial decision that should be based on your unique circumstances and goals. Consulting with a knowledgeable mortgage professional can provide insight and guidance to help you make an informed choice. Feel free to reach out at any time to discuss your options as well as your current situation to make sure it is the right fit for you and your family. In conclusion, the key difference between a variable rate mortgage and an adjustable rate mortgage lies in their payment adjustment mechanisms. With a variable rate mortgage, you will have some payment certainty, but this payment may not cover any principal versus an adjustable rate mortgage where you will always be paying down principal. However, may be in for a bit of a ride if rates adjust. Understanding these differences and carefully evaluating your financial situation and market conditions can help you choose the right mortgage option for you and your family.
In today's episode, we discuss the difference between a variable rate and adjustable rate mortgage and how the differences between them can impact your finances. We hope you found today's episode informative And don't forget to hit that subscribe button to stay updated for our next episode. Thank you for tuning in to Mortgage Foundations. And remember, every home starts with a foundation. Your mortgage should too.